Thank you for joining, guys. I am joined by Cara James, Dan Bailey, Peter Moenickheim, and Donna Osborne, who are going to talk to us today. We're going to talk a little bit about the SVP bank situation and things that are going on in the financial services marketplace right now. Why don't we start? I'm going to go kind of around the circle as I see you guys on my screen. Cara, do you want to quickly introduce yourself?
Sure. My name is Cara James. I am the Chief Risk Officer for Arvest Bank. We're about a $26 billion bank in Arkansas and Oklahoma, Missouri, and Kansas. And been very interested in seeing what's transpired this week, and looking forward to the discussion.
Dan, what about you? Would you introduce yourself?
I would be glad to, Kate. Thank you. My name's Dan Bailey. I have been involved in some level of an enterprise and operational risk for, I'll call it 30 plus years or so. Certainly looking forward to the opportunity to talk about what happened. Looking forward to hearing from this panel of experts as well.
Peter?
Well, hi, everybody. My name is Peter Moenickheim. I'm the prior Chief Risk Officer at Gateway First Bank out of Tulsa, Oklahoma. And in my life before that, I served as Chief Risk Officer for large institutions, small institution, banks, and non-banks.
Very good. Thank you. And Donna?
Hi, I'm Donna Osborne. I have been in the industry for 44 years. Sorry about the chimes. I have been a part of the growth of Bank of America from small state chartered banks into the banking magnet it is today. And along with that, I've had lots of discussions with risk and compliance folks and external regulatory agencies. After I retired from Bank of America, I spent 10 years building banks, fixing banks that were broken. And, all of it leads back to how is the bank managed, really. So I'm excited about this. I've been keeping tabs on what's going on. Had a couple of discussions yesterday and today just to make sure I understood exactly where we were going. So look forward to the discussion. Thanks.
Perfect. Thank you, guys. So let's start. Peter, if you don't mind starting us, can you explain for people out there who maybe are not in financial services or maybe just are in financial services but not as closely tied into kind of the risk situation that we're looking at, like what happened last week? Obviously, SVP kicked us off. Since then, we've had Signature Bank, we have First Republic Bank. Things are going down as we speak today with First Republic Bank. Can you explain in layman's terms what happened, what triggered it, and what was the actual root cause of SVP getting seized by the FDIC last week?
Sure. So, in simple terms, Silicon Valley Bank had their assets invested in long duration, low interest rate bonds, treasuries, mortgage-backed securities. And on the other side of their balance sheet, they had very liquid deposits. With interest rates rising, the value of those bonds, which was about 60% of their assets, goes down. Every time interest rates goes up, the value of those bonds went down. And so on a financial basis, there are some people who say that technically Silicon Valley Bank was insolvent in Q3 of last year. I don't know when the exact thing happened, but with the pressure on their financials, certain individuals started putting out bad information and encouraging people to take out their deposits. And so what we had is, I'm going to use these words very carefully, a new fashioned run on the bank. And I use the word new fashioned because this is really the first time that a run on the bank was incited by social media, and really the first time that bank deposits could be moved with the click of a mouse. And so we saw a rapid removal of deposits from this institution, which just accelerated the problem. So that's what happened, in a nutshell. I could go into the risk management framework and talk in more detail about, the gaps in asset liability management, blah, blah, blah. But at the core, that's what happened.
No, that makes it. Cara, go
I was
ahead.
just going to say, to emphasize something that Peter said, they lost $42 billion in deposits last Thursday. And we're recording this on Thursday, the 16th. So a week ago, they lost $42 billion. And what I have read is that the only thing even, and it's not close to it, but when Washington Mutual failed during the Great Recession, which was the largest bank failure we've ever had, the most they lost was 16 billion in a day. So just emphasizing what Peter said, we've never seen anything, we've never seen deposits just fly out of a bank. And it is certainly due to the technologies and the social media impact, which is hard to manage for.
Yeah, no, that makes sense. So let me ask this question, Dan, I'll go to you for this one. If there isn't a run on the bank, does all this happen? Or does it just kind of continue to go along and they continue to operate as they were before last week? Like Peter alluded to, some people will point to their balance sheet and say they were insolvent long before things failed. But if there was never a run on deposits last week, are we where we are today, or are we still moving along?
I don't believe we're anywhere close to where we are today, to be honest with you. At the end of the day, they would take the significant losses on what they would have had to have sold for those long-term investments, and that would have impacted, quarterly earnings, and, likely would have affected stock price and various other elements of things. But I don't think we're anywhere close to where we'd be today, just because the loss that Cara identified right there just has such an order of magnitude associated to it that it's kind of mind-blowing.
Yeah, no, that makes sense. Donna, since SVB, we've had I'm losing track of them all. We've had Signature Bank, we've had First Republic, which is going on today. Are those just reactions to SVB? People are taking a closer look at other banks' balance sheets, and now they're getting concerned about specific ones. Are they caused by the SVB collapse, or is it just a symptom of the same types of practices that led to SVB's downfall?
Well, I'm not in those banks, but I would say that there is some concern in the industry that once you see something like this, and I need to emphasize what Peter was saying, this is a unique situation. We've never encountered this before. If you go back to 1929, when you had runs on banks, and during the last recession, you never saw that much coming out of the bank at one time. And I think, again, triggered by social media, triggered by the ability to click your mouse button and move money. That is unique, and we need to be cognizant of that in the industry, and we need to focus on that some. But I don't think we need to overinflate it. We need to look at Signature, we need to look at Republic, even Credit Suisse. Credit Suisse was in trouble before this, so they're
Yes.
going to try to tie it in, but
Yeah.
it's a different story. So I think we need to sit back for a minute, breathe. Let's see what we can do from a perspective of some of the other banks that may be looking at their balance sheets right now. And, I was a operations person. I wanted to sell. I had more heated discussions with my risk management team than probably was invited. But at the end of the day, managing your liquidity, managing your asset pool, understanding what you've got where in terms of duration of the asset and the liquid nature of deposits. How do you balance that out in an environment that, they were in a kind of a stable rate environment for a while, and then the rates started going up? Did they react as quickly as they could have? Perhaps not. Could they have foreseen what happened? I don't think they could have. We've not ever seen it before. We don't have a history of this in the industry. So this is something that we're going to take away and learn from. But, what I would encourage is that we don't overinflate the situation and cause consumers to be unduly concerned or overly concerned and taking action, because that is just going to multiply the problem.
Yeah.
So breathe, leave everything alone.
Yeah. Well, and I want to jump on that with what Donna said, and also come back, Kate, to kind of the question. Signature was a very different situation, very different. So whereas Silicon Valley Bank had a large concentration on their balance sheet of these, long duration, low interest rate bonds. Signature was the bank for crypto. And they were relying, the estimate is between 70 and 90%. I think it was closer to 90% of their business was with crypto companies. And we know what has happened there over the last few months. And so they actually self-selected and said, look, we're going to self-liquidate because this is not a long-term business plan that's going to work. And when Silicon Valley Bank happened, the regulators came in and said, well, let's just take over Signature as well and manage the wind down of that, because again, they were fearful that there was going to be an additional run and then it was going to collapse. So they're different situations. One was caused by concentration in a business. The other was caused by concentration on the balance sheet of a particular kind of asset. But the thing I wanted to emphasize what Donna said is, I don't think consumers should be concerned, but I do think if you are a consumer fortunate enough to have more than $250,000, you should ensure that is split up across a couple of different banks, right? Because we cannot be sure that if this happens to another bank, that the FDIC is going to honor the deposits over 250, like is being done with Silicon Valley Bank. But if you're under the 250, I wouldn't worry one bit. The FDIC has always made good on the deposits under $250,000.
Yeah, totally agree with what Peter's
Agreed.
talking about.
Yeah.
Yeah.
I think it's a much harder conversation when you're talking about a commercial account and folks that are running payroll in particular. You're going to see millions and millions of dollars running through the bank. But individuals, back to that kind of personal accountability and ensuring that what your personal situation is. There's really no reason to keep more than $250,000 in any given bank. And I think it's also just important for your average consumer to understand what kind of bank
Yes.
you're in, right? I mean, I would say our bank, Arvest, is very much your typical, mom and pop retail bank, consumer lending, mortgage lending. We do commercial lending, but it's kind of more what people think of as your typical bank. And it can't be overstated. These are unique banks we're talking about. And yes, maybe you can argue that's where it starts, but you have to know, as Peter was saying, Silicon Valley Bank was the bank for venture capital and the bank for a tech startups, and they had a high risk model. I will say, from a CRO perspective, I would love to have been a fly on the wall of their ALCO committee. I mean,
Me too.
what in the world were they talking about? And didn't they do a shock analysis like the rest of us do? And what in the world did that, plus 200, shock analysis look like? And their stress testing their portfolio. It was a high risk business model, high growth business, and certainly they might have had a high risk temperament, high risk appetite. When you get to basic, risk management in a bank, a bank with good, effective risk management has a board approved risk appetite statement. You set your own boundaries, and you report on those metrics regularly, and you force that information in front of the board, and you aggregate risk when appropriate, and you peel it out separately when appropriate. And it's just hard for me to imagine that effective, and not conservative, but just moderate risk appetite around interest rate risk, market risk, liquidity risk, that they wouldn't have been trying to, change some of the practices they were doing. That's the part that I've just sat stumped about, frankly, all week. And then you hear things like, there's been a lot of chatter I've heard. And when you hear it on the mainstream news, you think, oh boy, you really wake up, talking about the chief risk officer this and the chief risk officer that, right? You get a little nervous if you're a chief risk officer. But, I have heard both that they never had a chief risk officer to earlier this year. I think a new person started in January. And then I heard that, no, they were just without a chief risk officer for 8 months. Well, let's say it's 8 months. That's a long time to be without a chief risk officer. You also get in a situation where we think big banks always have things all wrapped up and tight as a pin. And honestly, the opposite can be true. It's harder to control, especially when you're in, so many different countries that Silicon Valley Bank was in. But and certainly the crypto banks that we were talking about, that is a different discussion. And I think that was probably a political move. And whether you agree with it or not, the feds basically said, Signature, we're just not going to let this turn into a problem. And, their board, including, Barney Frank, and their executive management felt that they were stable, felt that that was a premature action. But, the government was looking at this in a more holistic way.
Right.
Totally agree with you, Cara. I think there's probably also the prospect of some guilt by association with what went down with FTX, right? Earlier in the calendar year, if you will. And I think it was somewhat probably of a knee-jerk reaction based on some of the fears and trying to allay fears in and around crypto, because at the end of the day, how many people truly just still don't understand it? And I would include that the federal government in that arena. They're getting better at understanding it, and they're trying to develop this, but it's nowhere near where to a point of maturity where they can make good, solid, mature decisions in and around that. And then you made a great point about the chief risk officer at Silicon Valley Bank, and I keep hearing the media trying to point to that. And as soon as I heard it, my whole perspective on that was, that's the wrong thing to focus on, truly. In the grand scheme of things, let's focus on the risk management program in general and how did it build and lead up to that point.
That's right. It shouldn't be about one person, right, Dan?
Exactly.
No, it shouldn't.
Exactly. You're fine. You're fine, Peter. Go ahead.
Sorry to cut you off, Dan. I question, this kind of dovetails, Cara, into what you were saying about a fly on the wall in ALCO, but I'd like to be a fly on the wall in the risk committee of the board meeting.
Exactly.
Right? I mean, what was the governance here and what action was taken? Because as you said, Cara, you would expect, as would I, that an institution of this size and complexity had a risk appetite statement and risk appetite metrics and a robust contingency funding plan. Well, when the lights started blinking on all these appropriate indicators, right, what did they do? And if they were blinking and did nothing, that's worse, I think, So we're going to learn a lot. This is going to be a business case and, MBA programs and banking school and all that. But yes, they should have had a chief risk officer if that chief risk officer had the appropriate empowerment to be part of the decision making, right? But really it comes down to, what was the governance? What was the governance from the risk committee of the board? What was the governance in ALCO? What was the governance process in the risk committee of management?
I would agree with you, Peter, and you're saying, were the indicators blinking? And my real question was, were the indicators even in existence?
Right. Yes. It gets back to Cara's point. Yeah.
Yeah. And I see, my mind immediately went to, well, when the 10-year yield curve started to flatten, shouldn't somebody have done something? Or when it started to invert, shouldn't somebody have done something? Wouldn't you have sold off and taken a smaller loss than what they actually ended up taking when they had to actually sell?
Yeah. The blinking lights should have been going off. And in my opinion, based on what we know today, they should have started to rebalance that bond portfolio over the last 9 months, because there was no indication, not from the Federal Reserve, not from anybody in the industry, that rates were coming back down soon. So this problem was only going to get worse or it was going to stay where it was. And so there's some negligence here that they didn't take action soon enough to try and rebalance that portfolio.
Absolutely. And I think to your
Every
governor,
bank's been dealing with this, right? I mean,
Yes.
everyone's dealing with this. We all have an investment portfolio. We all found ourselves with, or many of us, I believe a large percentage of banks found ourselves with a maybe a larger investment portfolio than we've had in many years. And you know, I had heard that the average maturity there was 6.2 years. I've heard that from one source, but if that's the case, you know, that's a little hefty, and you're going to want to be looking at that. When is this stuff maturing? When is this trailing off? What are we going to be doing about that? And you know, a lot of banks were and are sitting on some unrealized losses, but it's just, you hate to start pointing fingers and say risk management must have been terrible, but there's a story there somewhere, and it's going to be interesting to see how it unfolds.
yeah, the overall
like
governance
to-
aspect,
it gets back to, you know, one of the risks we always look for as chief risk officer is concentration risk, right?
Yes.
In the loan portfolio, are we too concentrated in an industry? You know, are we too concentrated in geography? Diversity is very important, and it has to be on the asset side as well. And when I hear that 60% of their assets were in these long-term, low interest rate bonds, that's a huge concentration risk. And so, as you said, Cara, a lot of banks are going to have you know, an impact here and may take a loss or two on a few bonds, but you know, very few had 60% in this asset class.
That's
and
right.
I think they were over concentrated and didn't diversify and didn't take action.
I'd like to come back to the risk piece in just a moment, but I have a question first for people who maybe don't fully understand this piece. Donna, maybe you can help us with this. Since the SVP ordeal last week, the Fed and the FDIC has obviously gotten involved, and there has been statements issued that are going to allow them to back all of the deposits that were in SVP so that there aren't going to be any losses from depositors. Can you explain for people who don't understand that piece what action has been taken to make that a reality and how the government has got involved into this situation?
Sure. I do think that the first thing folks should know, and maybe there are people out there that don't, is that banks pay into the FDIC on a regular basis to cover these kinds of losses. The banks are charged a particular rate. There is a concern that may go up, but let's not.
I'm sure it will.
I'm sure it will also.
Let's not get folks.
We can bet on that.
Yeah.
Yeah. Let's not get folks excited about that, though. I mean, the bottom line is there was money to cover these deposits, and they will cover the deposits. That is something that is guaranteed. And let's go back to that 250,000 per person per account. We need to be cognizant of that. You know, if you have an account with your husband and then you have an account by yourself, are you covered? These are questions that people will likely be asking or should be asking. And our teams on the field in the various banks, in credit unions, in wherever they are. Well, credit unions are governed differently, but you know, they need to be able to respond to customers and tell them this is how you should you know, manage your accounts. This is how you should name them and whose social you should use. I think that's important. Again, let's breathe for a minute. Let's not get the customers excited. They don't need to be excited. And I go back to what Cara said. These are very specific, unique situations. We've not seen this before. We've not seen a bank that is so focused on startups, venture capital, tech industry, and kind of just creating their own. These are my words, nobody else's. Kind of creating their own rules in terms of how they wanted to attract their customer base. And then you look at Signature, which is, you know, the whole crypto thing is scary to begin with. I know the Fed was doing some work trying to understand, get their arms around what's going on out there. But, you know, you can't take individual scenarios that are unique to those banks and apply them across the board and say, oh my
Right.
gosh, all banks are going to fail. That's
Right.
not going to happen.
Right.
So again, educate your frontline teams, let them be able to clearly articulate to customers what their rights are, what their benefits are, make sure they're given disclosures, whether electronically or on paper, so that they understand what they've got and what they could get in the event of some sort of a disaster like we've had with Silicon Valley.
Yeah.
Did that answer your question? Yeah.
You know, we always say to our customers, based on what Donna just said, that if they just Googled EDIE, EDIE, FDIC, they'll come up with the electronic deposit insurance estimator from the FDIC. The banks I've worked at, we always say we don't want every one of our people on the front line trying to help their people with this, right? Too easy to make a mistake, a little bit of liability there. But we always reference to our customers. So if we have somebody out here watching this that just doesn't know where to turn to learn more about this, it's edie.fdic.gov. And that talks about how to estimate in their own personal situation what insurance they might have on their deposits.
Yeah, and
That's
I
a
think
great
to
tip,
a point,
Cara, because
yeah,
I mean, I agree with Donna. The front line needs to be educated on what to do and how to deal with the consumers, definitely. But I think your solution to point them to, a trusted source like Eddie at FDIC.gov is a great one, because it takes some of the liability and confusion out of it.
I think there's some risk mitigation that can be done for the future prospect, whether that's short term or long term as well. To Donna's point about, I think there's going to have to be some communication put forward, right? There's going to need to be the communication that confirms we as an institution affirming to our customers we're in good shape. Things are positive here at this particular institution. So, Cara, the perspective from Arvest, Arvest is in good shape. Here's where we sit, with regard to the investment portfolio. We're not in danger. Our deposits, our liquidity and capital, and all of these other things are strong. I don't think it's going to hurt to do some kind of, preliminary communication to allay the fears of any of the consumers that may be really fretting about what should I do, or should I do anything at the end of the day. So to Donna's point, I think it's important that there is a level of communication that's put forward here. So
yeah,
we put that out for our public, folks that are interested in our bank and our customers and the public beyond. We also put out a video with some of our executive management talking to our associates. We also put out some FAQs, right, for our front line to be able to handle certain inquiries. And certainly we have a central PR group where, they're handling those press inquiries and that kind of thing. So it's kind of an, all hands approach to handling this, just to let folks know that, we don't look like any of those banks that failed, and that, where they can go to understand deposit insurance, and that we have the availability to borrow, using various sources of FLB, the new Fed resource, the discount window. We have lots of options open to us at Arvest, and some private sources as well, if things were to get tricky. And I just think transparency with the public, and the more folks that get out there and say, hey, these banks, this wasn't none of these were mom and pop banks, if there is such a thing, but they're not your standard retail / small business type of banks.
Yeah, I'd use the word traditional, instead of
that's a good word, yeah.
Right. These two, neither Signature nor Silicon Valley Bank were traditional banks, and traditional banks, you should have no worries.
Yeah. And I can't remember, Peter, if you mentioned Silvergate, but we could throw Silvergate out there. That was a crypto bank, and that's recently gone down, if you will. But Silvergate really kind of unwound themselves, being in, again, having that significant crypto exposure. It was not a government intervention, but again, very unusual situation.
Yeah.
Very
And for
unusual, very unique.
for all of the surviving institutions, I think this stresses the importance of having a good crisis management program in place, because part of crisis management is the communications aspect. So, business continuity, how do you set up for and plan for external events and that type situation. While this was a combination of internal and external, a good strong governance program in and around that, I think it stresses the importance of that as well. So
Absolutely.
I have a question on, I want to talk to, back to something that we've hit on several times. Like, if you are a financial institution and you're evaluating your risk environment and you're trying to learn from the scenario, as multiple of you have said, this is the first time in history where the combination of social media and the ability that I can get on my app for my business account and immediately transfer money to another account in like 30 seconds in large volumes, that's never been accessible before. So from that perspective, knowing that customers have the ability to move money so quickly, and knowing not even in banking, but think about the inflation of GameStop stock a couple of years ago where social media just pumped it,
Yep.
like the ability to incite behaviors across social channels. How does that change your job as a financial institution in evaluating the risk that you're dealing with on an ongoing basis? Peter, let's start with you because you're nodding your head heavily, like you got lots
Yeah.
of thoughts.
No, I mean, I think that's going to be one of the great learnings coming out of this, right? And I think it's going to force the proactive banks to look at this and come up with plans. And I think ultimately it's going to end up in exam manuals from the regulators, and they're going to want to understand, do you have an understanding of your customer base? And do you have, as Dan mentioned, a crisis management plan should something like this happen? And I'm not going to inflame the fire, but I did read an article this morning that there was a sell side analyst who was sort of pushing the narrative for a particular bank that they were in trouble, trying to bring their stock price down to help facilitate a buy side person to do a merger with this bank. This gets very dangerous, right?
Yeah.
And it's just like you said with the GameStop situation. It is bad information being cast out there as truth, and it's causing some of these things. So I do believe we're going to see better guidance on how to deal with social media hype, and also I think we're going to see more guidance on understanding the diversity of the deposit base and the makeup of the customers. We used to say, core deposits, that's the rock that banks are built on. Well, I got to question now, what really is core when it
Right.
can move at the click of a mouse?
yeah. Well, and Peter, I think something that just literally came to my mind as Kate was asking this question too, centers around the fact that this ability to go to the app or to the website or whatever and move large amounts of money, for most banks I'm aware of, really is only capable on the commercial side of the house, the business side of the house. As an individual consumer, I can only move a small amount of money through an
Right.
ACH transaction on a daily basis. Then on a monthly basis, I've got limits set on me. What really if once the data is fully analyzed, what I think we're going to find out is the ability for these businesses to move to create wire transfers at no limit, essentially, to be able to close their accounts down and move it to a different institution. That's probably another aspect of a learning opportunity in what's going on here as well. So because it is electronic and it is not something that we're as used to seeing, because we haven't seen the bank runs in that digital format. We would always see the runs, people going into the branch, I want all my money out, right? So I think it was Donna maybe that said it was not the traditional, or maybe Peter, it wasn't a traditional run on a bank. It was the new The
I
new
call it
type-
new fashioned run on
New
the bank.
fashioned.
Yeah,
That's
Not an
I
what
like
it
that.
is.
old-fashioned.
I wrote that
New-
down.
Yeah. Yeah.
I do think and I don't want to take up too much time talking about good practices and good policies, but every bank I've ever been associated with on the commercial side of the house, each customer is analyzed for their risk tolerance. And
Right.
as Cara was saying, you have a risk profile that's board approved. You have your customers that should be reviewed to understand what they can and cannot do. And some customers, sure, some commercial customers will be able to initiate their own wires on their own application for 700,000 or whatever. Most of your commercial customers, your smaller corporations, will only be able to transfer money by a click of the button based on their risk profile. So, I keep looking at that, and I'm sorry, it just keeps coming back to, were the corporations managed appropriately from their risk profile? And then you look at, what was the banks, were they, I'm guessing they were high risk. I'm guessing because the businesses that they catered to, but that's just my assumption. I don't have any idea what their board approved. And I keep coming back to that. Did we manage the corporate customers
Yeah.
correctly?
Yeah. And, I'm going to come back to governance, right? Managing and overseeing an institution of that size and complexity, you need the right talent on your board risk committee. And early reads that I've seen say that there was very little risk management expertise on the risk committee of the board. Well, Danger Will Robinson, that's a big warning sign, right?
Mm-hmm.
This is not a small community bank where everybody knows everybody, and the board is more generalists, right? This was a
Advisory.
complex, right? Yes, thank you, Cara. This is a complex, large institution, and on their board, especially on their risk committee of the board, they should have had people that understood banking and understood risk management.
Well,
I mean, I think every bank should have that, but the more complex and big you get, the more you need that expertise.
Peter, I actually heard that there was very little banking expertise on the board itself.
Yes.
That you had a lot of these joint venture guys and you had a lot of these tech folks. And, honestly, where were the regulators?
Yeah.
Because that's something that's easy for them to assess. And that's something that, well, there's a lot of ways we could maybe say that. But where were they just in terms of the expertise of the board itself?
Yeah,
That you
general
would
safety and
that should have been
soundness.
something that was dealt with.
Yeah,
Yeah,
absolutely.
I agree,
General
Karen.
safety and soundness, in regard to the exams and such, certainly has to come into question here. But the lack of expertise on the board creates the opportunity for only dumb luck for them to ever possibly ask the right questions. And
That's right. Well, and it
for-
also, I mean, if you're talking about venture capitalists and tech folks, you're dealing with high risk mindset. You're dealing
Yes.
with entrepreneurial spirit. And I think we all know, and there was data to back this up in terms of boards and the composition of boards during the recession. You've got to have more folks with a risk mindset. And clearly no one got that memo at this bank.
No. And I don't want the people listening to this to think that you can't have a bank with a higher risk appetite.
You
That
can.
just you can. It just means though that the risk management infrastructure needs to be more sophisticated.
Commensurate, for
yes.
sure.
Exactly. That's my point.
well, and the controls that are in place obviously have to be commensurate. So for that high risk financial aspect, you got to have more liquidity, more capital, whatever that might look like, right? Operationally, there's all different kinds of controls you'll have to put in place. But to your point, Peter, I think it just goes back to governance whether that's risk governance or whether that's just the overall governance for running the bank on a day-to-day basis.
And
I would
so
say
there was,
they need to evaluate kind of their PR.
Oh, yes.
You know, when the CEO goes out and is kind of being very transparent, which, as an investor, maybe you like that, but I don't, some of the stories I've heard, I don't think he did his bank a lot of favors. And in a way, it was characterized as being naive. He wasn't sitting there thinking about folks going nuts on Twitter or Facebook or, and if we're dealing with cool tech people, it's probably more like, I don't know, something I don't even know about, right? Or Instagram or whatever. But folks were, talking about this, and they gave them a lot of ammunition reason to think that there was a problem. And I can just picture that, at the top of the house, they weren't sitting there thinking about social media and how these things can spread like wildfire. I heard one analyst say, could this guy not have gone and gotten an investor real quick or gotten an infusion of capital somehow? Surely there was a better way to deal with this. How about, even you can argue the regulators, would nobody buy this thing? Really, nobody might have bought this bank on Monday morning. I don't know. It's easy for us to sit here and second guess, right? Some of this stuff is more obvious than other parts of it, but it's going to be a fascinating, as you said, business case.
Yeah. Well, and you're right. It certainly is easier for us to Monday morning quarterback this whole thing, but it does highlight some of the basics. As you said, where was Alco, right? What was governance? Where was the right expertise? And I would ask, okay, where was their contingency funding plan? And, right?
What did that policy say? Where was that policy? And what did it tell them to do in this situation?
Exactly. And, if they did that plan correctly, it has tactics in there when certain thresholds are met. And, that would include, getting investors or other, capital. That's not something you do as the bank is collapsing. You should have done that months ago when the lights started to blink on your indicators.
Yeah. Well, and I'll even circle it back to, okay, they were without the chief risk officer for 8 months. And a lot of what's being published right now is the golden parachute, essentially, that the chief risk officer deployed. But is anybody asking the question, so why did the chief risk officer really leave? And can we get the real answer to that question? I think that could start to produce, let's call it, several implications. So
yeah, it's always good to do a postmortem on that. I mean, even when you have a compliance officer leave or a BSA officer leave, did they do that because they were uncomfortable?
Mm-hmm.
Right.
Yeah, that's interesting. So I have a question on one bank that we haven't really talked about yet, and that's First Republic. But as of a couple of hours ago, my understanding is that the U.S. government was trying to orchestrate a rescue of First Republic, including many of the big players in the U.S., J.P. Morgan, B of A, Citi, Wells. I'm curious, for those who don't understand, if you guys could help them illustrate the situation of what's going on there. And then B, for those who really don't understand, why does the government and these other major banks who theoretically would be competitors to First Republic, why do they have an interest in participating and helping them out, for people who don't really understand how that piece of the banking market works?
Yeah, so I just want to make sure people are clear. Again, this wasn't a bailout. This actually was many of the names you mentioned, Kate, plus a few others, Truist and a few others, came together and are depositing $30 billion with First Republic. Okay. Yep. Banks deposit money with each other all the time for various reasons. And your comment about competition, yes, but think about the core of banking is a business of trust and confidence, right? And so those other banks have a vested interest in stabilizing the banking industry. And I think this is a show of their confidence in First Republic that say, look, we're going to put $30 billion on deposit there. and hopefully that, well, definitely it gives them, the liquidity that they need, but hopefully it also gives confidence to their existing customers that First Republic is here to stay, right? So there's been no government involvement in, quote, bailing out First Republic. The government helped coordinate the depositors, but it is just a large deposit into First Republic Bank.
I'm reading here it's 11 banks. I think you bring up the bailout term. We do need to be clear that
Did I say bailout? I don't think I said bailout.
Peter did.
Oh, okay. I was gonna say, like, I think Peter interjected that. I didn't say bailout. I just said, like, it was.
Well, and that's why I'm just going to clarify for the folks that maybe aren't as knowledgeable about the situation, that when it comes to SVB, that they bailed out depositors above and beyond what they were insured for, but they are not bailing out executives and shareholders. You also have the
bondholders.
Pardon me?
Bondholders.
Yes. You also have the complication of, some executives selling stock, supposedly. Now I just read a headline that said there's some of that was going on at First Republic. So, that's the dark side of this whole thing, as if the regular part wasn't dark enough. But, we need to be clear when people talk about a bailout of Silicon Valley. Well, depositors, yes. Everything else, no.
Right.
We need to be sure people understand the difference in that.
And I've seen a statistic recently from a chart that said almost 94% of Silicon Valley Bank's deposits were uninsured. From a First Republic perspective, it's close to 68% of theirs were uninsured. The one above that is Citibank, but Citibank's got the asset size and the volume to be able to really cover themselves, where I don't think First Republic had that capability, which is then why you get that $30 billion infusion.
And why is that? Just for people who might not understand, Dan, is that just because they're big commercial, like payroll accounts and commercial accounts that are carrying large volumes above like the insurance limit from the FDIC?
Yeah, I think so. At the end of the day, when you look at the big four banks, everybody is over $1.5 trillion in asset size, which means their liquidity, their capital, and everything is going to be at a much larger pace and scale than a First Republic.
Right?
Yeah, than a First Republic or a Silicon Valley Bank. Silicon Valley Bank was $209 billion. Off the top of my head, I don't know what First Republic is, but they're not going to have that ability to say my liquidity and my capital is literally at the hundreds of billions of dollars level potentially. So First Republic's not going to have that. So I think it's a good thing. To Peter's point, it shows that a trust factor in being able to say we're going to do what we can as those massive behemoth banks to stabilize the U.S. banking environment and culture.
So I just looked at it. Says total assets for First Republic is $212 billion. So is that right? Still, if that's correct, a very significant size bank. My understanding was there was a lot of wealth customers in First Republic.
Yes.
You got a lot of individuals that have exceeded the insurance amounts and kept their money.
And on top of that, First Republic essentially has lost over 27% of the value of their investment portfolio with the long-term investment issues that are going on right now. So
no, that's good information. So we've gone for almost an hour, which is awesome. This has been a really good conversation. I do want to be respectful of your guys' time, but if I was going to summarize what I think I've heard from you all, specifically for consumers and customers for banks out there, the banking model is strong, especially traditional banks. There's no need to be concerned with traditional banks. Many of these that have had issues have a little bit of a non-traditional business model and maybe more risk tolerance. But there is concern in consumers, and the onus is on financial institutions to effectively not only communicate with their customers on where they are from a risk perspective and to educate their customers, but also to make sure that they have appropriate risk mitigation and governance in place to make sure that they're considering all of these factors, especially in our current environments, and to really study situations like this and how social media and the ability to quickly transfer funds can have an impact that we've never really seen in the financial services market before, because of how quickly you can have a run on deposits if there is a scare that drives people to action. Is there any other points that if people watch this video and they make it all the way through, thanks for getting this far, by the way, if you do, but if you watch it and get all the way through, is there anything else that you would like to summarize? We'll go kind of around the circle, that you would like people to take away from this situation, either banks themselves or the consumers, that they should consider when thinking about what's happened over the past week or so. Cara, let's start. We'll just go around the circle again. What about you?
Well, I would say from a consumer perspective that, you know, if banks do the right thing, they're communicating with their customers, but I think everyone has personal accountability. And you got to know where your money is. You got to know how much of your money's there. You've got to understand the risks you're taking as an adult individual, and understand how the basics of what your bank is, where they are located, and how they make money. And I just think personal accountability is something that we put too far down the list sometimes. In terms of banks themselves, I think we've hit the big points, but some of I'll tell you, my learnings coming out of this is crisis management, wrapping my mind around that. What if a bad rumor got out there about my bank? And what are we going to do? I know exactly in my team, and by team I mean our entire company, where I would go. How we're pretty nimble in that way, but it's always good to kind of think through scenarios, and that's some of my learning coming out of this. As we talked, I made some notes. Right, the crisis management piece. Really understanding. I know we've got that information about diversity of the deposit base, but I don't have it off the tip of my tongue. Right. And which I have a lot of our metrics and understanding of our company just right off the tip of my tongue, but I don't know that. I can make a super good, I mean, it wouldn't even really be a guess, but I don't have numbers, right? So going back and looking at that reporting and ensuring that type of reporting and understanding gets all the visibility in the world. I know that look at the quality of your treasury folks, right?
Yes.
The folks managing this work, do you have the best and the brightest? I feel like we do at Arvest. But I think if a bank, and maybe especially a smaller bank, if they're wondering if they've got the horsepower, better figure it out, right? Figure it out. In this day and age, you want the best in that space. Just watching what's going on and watching that portfolio, making the right decisions.
Yeah, that's good stuff. Peter, what about you?
I mean, I would echo, majority of what Cara said. My message to consumers is how I started our session is, if you're fortunate to have more than $250,000 with a bank, split it up. The average customer doesn't have that amount of deposit. And if you're banking with someone that's FDIC insured, you should have no sleepless nights. The FDIC has always made good on the deposit insurance. For business customers, I'd echo what Cara said. Understand your bank's business model. You may want to be better informed about what they do and how they do it. And for bankers, this is a lesson in risk management 101, right? Asset liability management, governance, crisis management. Be sure you've got smart people looking at this, and if you can't get them, rent them. Right? There are a lot of people you can get a couple of hours of their time that can give you good insight into what you should be doing here. And I point that question more, as Cara was talking about, to the smaller banks, right? Yeah, okay, you're not going to be able to have a huge treasury team, okay, but there are people that can bring you that insight at a fraction of the cost and help you manage through your ALCO process, your interest rate risk scenario testing, et cetera, et cetera, et cetera.
No, that's really good insight. Donna, what do you think?
I don't have a whole lot to add to what Cara and Peter have said, other than my comment about consumers should just take a breath. There's a lot of speculation going on right now, and everyone that is doing any kind of reporting or writing any kind of articles is an expert. And
Mhm.
as
Mhm.
we've said, we've not seen this in the industry before. These are firsts. So, and with firsts, we need to understand exactly what happened, gather the lessons learned, and if we need to do some shoring up, we'll do that. But we need to just sit for a minute, because if everybody starts going and taking their money and putting it under their mattress, we'll have a financial collapse, and we don't need to have that. And that would be all I would add.
That's great. Dan, best for last. What about
Uh,
you?
Well, I don't know about that, but thank you. Um, I would definitely echo what's already been said. On the consumer side of the house, I agree with Karen Peter, the personal responsibility. Agree with Donna, take a breath. One of the things I always tried to preach as I'm meeting with various people around the banks is helping them understand the reality behind the fact that every one of them manages risk. They're all risk managers. Well, as consumers, we are too, and it's our own money that's at risk at that point. Whereas you work for a bank and it's always somebody else's money, if you will. So, as a consumer, if we're going to manage our risks effectively, I think it's going to be important that we understand the structure of the banks we're considering putting our money into or considering going into a relationship with to, to really determine does it meet my own personal risk appetite, right? Which you're the only one that can set that. On the bank side, again, agree with everything that's been said so far. I think it's all of this is going to require and demand strengthening various areas of risk. I think the ALCO, to Peter's point, is definitely going to be there. A point Cara brought up earlier, I think model risk management in general is going to have to be strengthened, and even above and beyond that is that real solid governance perspective of being able to raise your hand and say, we've got a problem. I had a CEO that I used to work for that said, if we've got a problem and you don't raise your hand, you have a problem. But if you raise your hand, then we have a problem. And there's going to have to be a cultural perspective brought to the table at banks across the country, I think. Let's call it around the world even, that says we have a problem, then let's together we fix it. We resolve it. So I think some changes, overdue and needed changes, are going to really have to be considered and really demanded, if you will, if not by the customers, whether they're consumer or commercial, or by the boards or by the regulators. But somebody's going to have to really get to a point where it's demanded that these changes really are brought forward. And it's more maturity from a change perspective, I think, than it would be wholesale, let's add this. They should already, every bank should already be doing it. Let's mature it. So
Yeah, that's good stuff. This was fun, guys. I really appreciate your time. I really appreciate the conversation. It was very informative. I learned a lot. I really appreciate all your perspective and the fact that you guys were willing to hop on and share. And I hope a lot of people watch and can learn more about the situation. But thank you very much for your time, and we shall chat later.